All right, this is different than I normally do here in a Market Week show. I'm going to do a major market review looking at the dollar, gold, silver, Treasury, Bitcoin, and the stock market. And I'm going to show you cycle analysis at its best. I do want you to see the kind of work we do, how these correlations work together, and then for you to see how you can learn how to do this style of analysis, which I think will just change your own whole world of analysis. Is you can take it and apply your own work to it. So take a look here as we begin this major market review, and I'm going to start that by looking at the dollar. Just a quick little primer in here. That cycle analysis is analysis that shows the energetic rhythms in the market. It's essentially money flow done in an observational way. And we add in our own indicators, support, resistance levels, and on the bottom here are cycle brackets, which are simply a drawing tool which helps us understand the energetic flows in the market in different time frames. You can see in here on the dollar that there's this big, what we call harmonic family right in here, and there are minor half cycles. So this cycle right in here, this minor half, had a little bit of an early low, and then it rallied again because this was a positive cycle right in here with this low well above this low here. It gives you a strong indication that the next rising phase will go to new highs, and it certainly did. We use our reversal scout right in here, which gives us our momentum conditions, and when momentum is positive, you get higher prices, and you can see that this is where it turned up. You could see that green arrow that I'm using to point right there, and it actually stayed positive. This was barely neutral, went flat and stayed positive through most of this whole time. And here you see the significant downturn right over there, which warned us that we were coming into this corrective period. Our downside targets that we showed when it was way up over here was that it would get down into this support zone, these dominant supports, and that was going to be somewhere under 107 to maybe down over here. We had another one at 106.5 on the daily chart, but I'm not showing daily charts right now. I'm just looking at bigger pictures. So this support right over here is on the monthly chart around 105. So we think that is kind of the worst that we'll see in here. Now, this is important because remember that the dollar is trading inversely to the stock market, or the stock market trading inversely to the dollar. That's not historically true, but it's what's going on now. And the big influence is that when the dollar was very strong in this safety bid, and because of the interest rate disparity between the US and other countries, the dollar got bid. That hurt international stocks, companies' earnings prospects, and the stock market was weak based on it. When the dollar turns down, then the pressure comes off, or those headwinds come off earnings for the international companies, and then the bids come in, and you can see that happening. So this big downside movement here correlates to big upside movement in the stock market, and this points to, well, maybe another 3 to 6 weeks of decline here in the dollar, and that is in alignment with what we're looking for as continued upside move in the stock market. So I thought that was an important thing to look at. So the cycle analysis told us that it was going to make a peak and then come down in here. These extensions up here gave us levels to where it was likely to find resistance, and it did. And now we're showing the supports in here and the timing sometime between here of the end of November and the end of December as the time period when the trough will form, and then the next rally out over here. Remember, if this is accurate and you get the low here and you get the rally here in the dollar again, that means interest rates are going to be going higher again, or not coming down the way that people expect, and it also is going to put pressure on the stock market. So this out over here is a time frame where the stock market could be getting hit, February, March, and we've been talking about that potential. So I want to talk these correlations so you really understand. The gold market, we were looking for a major bottom in here. Now, what we thought was that this huge pennant, and the monthly charts that we look at were supportive of that this huge pennant you see right over here was a big consolidation. We actually expected that it would hold this support right over here, but it continued and then got a breakdown under this level. That then reduces our upside target because this low is below this low. You can see this big a cycle right over here. Now for our members, this is revised since we sent out our last revision, which shows 18-week and 72-week cycle. And this is the silver cycle right over here. So you can see how it aligns to some correction out over here at the end of the year. And this bottom that formed in here was late. You could see that it likely shifted. It took longer, and that happens sometimes when you have conditions were such that the sellers need to capitulate, need to sell out enough, and you could see, well, they did that. We believe this is a major bottom that's formed in here. Upside targets were in the high 1700s, but now we're upgrading that, and we're looking for somewhere out over here next year into 1850. So it might come even sooner into the early part of this year. So the gold market made that important bottom. You can see that as it blasts away. The supports right over here were at 1622. Based on this low that it made here, it tried to get under and couldn't, and then moved up. So it's in these minor resistances right over here, which is 1782 right there, 1798 here, and then 1850. And it got through this one here. Now this is the area right over there in the high 1700s that it might find some resistance and then begin to have some pullbacks in here, but we don't think that's going to get anywhere near that 1620 low down over there. And so maybe a lot of chop between high 1700s and low 1700s before it then begins to move up again. So gold, a much better pattern that it had. Silver has been stronger than gold, and silver made just a beautiful and rare a diamond bottom in there, and then had a breakout from that diamond bottom, as you can see. Now these yellow ovals in here really are beautiful. They show you where the periods of risk come in when cycles begin to nest. The dominant cycle coming down, the intermediate cycle coming down right over here, and there happened to be a gold cycle coming down at the same time. That brought this big decline. You can see right over here where they're coming down, the big decline, the big decline, the big decline right here, and it ran a little bit late, just as the gold market did, but it made this diamond that made the breakout and then got up to some resistance. There is some resistance, as you could see, at this 50% level right over there, which is the middle, 38.2, 50%, and 61.8, and backing away from that area around $22, and likely to, again, we're looking for kind of a choppy time period in here, maybe just over 22, and then coming out somewhere down over here into the December period before then blasting to the upside again, and then probably approaching this area of 2360 up there. So beautiful diamond breakout, positive conditions, a major bottom that we were looking for to form in there that came just a little bit late. See, the right over here is the ideal range based on the normal variances between these two verticals, and it came just a little bit late right over there on the late side, made its bottom, and then moved up. So very, very important bottom. Of course, there are resistances up here that it needs to get through, and because this is so negative, as this dominant cycle made a lower low, it says that the upside in here may be tough to get through because of this formation, and it may have a lot of work to do. That it has to build out a big base that may take all the way out here until the middle of next year, or August is what this looks like. So it could be a very wide, choppy base building period for the silver market and for the metals markets. But again, a very nice breakout. We're really targeting up here, up to that 23.5 area out here in the next coming couple of months in the silver market. So if you remember the dollar, we said 3 to 6 more weeks on the downside. That certainly should support 3 to 6 more weeks on the upside right now in the silver and gold market in this near term. Now let's look at the Treasury market. We had been extremely bearish in Treasuries, and we saw what we call a breakdown and a left-hand translation. You see this big cycle here, and it was taking forever to put a bottom in here. It was just moving to the right as the selling was just so extreme. This cycle right over here, you see it's slightly lower than where it began, and then when it failed here and broke underneath this low, it told us there was big trouble around. We had this label as an extreme left-hand translation. What that means is that this big cycle over here peaked way on the left side, and this was a left-hand translation. This was a left-hand translation. All of these things that I show you in here were pointing to much lower prices, failures in resistance zones, and then hitting this fib target zone that you see colored here in that blue color. And now where we are is finally getting this rally in here. We're looking for about 113.27, maybe up here to this dominant 23% at around 115. That's probably the best levels we're going to see in here. Now, this bottom is forming, but we don't think that the action that we have in either in inflation, which we don't think is going to give a ton of ground, and the Fed needing to stay tight for a long period of time, don't really think interest rates are going to get a lot lower. But take a look here at this interest rate chart. Magnificent cycle action, and we were looking for a move to the downside in interest rates, as we were looking for a move to the upside, of course, in the Treasury market. So it made the high here at 4.33 yield, and now our target right over here is at about 3.65 on the downside, and this likely to continue to decline out over here into January. That means that the bond market is likely to continue rallying into January. So that's about 6 weeks, and if you think about what we said in the dollar, which is likely to fall for as much as another 6 weeks, this is in alignment with that. So these correlations are just beautiful, and these troughs really point to sometime in mid-December where those lows are, but it could get all the way out here into early January. And this momentum in here, as you can see when it turned up here on the reversal scout, this is a level 4 proprietary indicator, so you need to become a level 4 to get this on your charts. This really gave you that sign that it was strong momentum for the interest rates. It's not even giving it up in here yet, so it's probably another week or so before we get the signal it's turning down, but you might have another as much as 6 weeks of decline in interest rates. That would be supportive to the dollar. That would be supportive to the gold and silver market. So that also aligns to the stock market remaining strong into the early part of next year, which is what we were looking for. So all of these things correlate, and that's part of why I wanted to show you this more extended analysis today. Let's now look at Bitcoin. And as I said early in the show, the crypto market is in chaos. And we have been extremely negative on the crypto market, with all of these nearly 20,000 or more cryptocurrencies that are out there, including all the altcoins. And we said it was growing, unlimited supply. And we believe that the crypto market was just part of the massive speculation from the insane action of the U.S. government and the Federal Reserve and worldwide central banks, that they were really stimulating a speculative fever that we saw in SPACs and NFTs and everything. And that when this was over with, you're going to see these 20,000 cryptocurrencies just melt away, maybe 80% or 90% of them disappearing or going to levels that are basically worthless. And you see that happening right now. Let's just take a look at this cycle period right in here. And it's important that we discuss again this FTX collapse. They have had liquidity issues. Binance said they were going to buy out, then back out. When they saw all of the liquidity issues, FTX filed for bankruptcy, and the CEO, Bankman-Fried, resigned. The BlockFi also freezes withdrawals, and there is chaos in the crypto casino. And if you didn't watch the crypto casino that I did months and months and months ago, that video, that is available on YouTube, and you'll be able to see when it was just much, much higher in the 50,000s, how I believed that it was going down at that point to below 20,000. And now we're looking like this is moving down to a level that may actually reach 10,000 down over here. Our target for this downside move was down here at these levels here. This is around 13.7. This is around 13.6, right in there. Those are the levels, this fib target area that we were pointing to. This cycle right in here really is becoming dominant. You could see this move to resistance and then the failure. Just let me get a little closer look right over here. There are two cycles. We're looking at this gray ghosted one, which could give you a low, and then this one out over here. So this is mid-December. This over here is in February. And we think that it's going to be a continued downside move in here. The question is, will this 13.5 area hold it? There is so much time after this breakdown under this level out to here or here that it makes sense that it's going to get to 10,000 or lower in here. And this is really the end of, or the beginning of the end, at least for these cryptocurrencies, the people in there that believed that this was going to be the way out of fiat. It just makes no sense. Governments would not let that happen. The market just grew way too big, way too fast. And if digital currencies are going to be the way of the future, it's going to be a while before you sort out which are the ones that really allow good privacy and peer-to-peer action that the regulators don't just destroy, and that'll be a while. And Bitcoin may be one of those, but it may be at 5,000. I mean, we really don't know. That's not my projection. I think 10,000 is pretty reasonable here, and 13.5 area is very likely here in the Bitcoin market. And if the decline in interest rates and everything that is supporting these other markets can't do it here in crypto, you really get the problems in here in this market. It is in chaos, and the wipeout is underway in the cryptocurrency market, and it will be a while before we really know how this sorts out. Liquidity issues from this contagion, which really started really long ago before FTX, I think that that is going to continue. Really horrible, broken market here in the cryptocurrencies. This is the stock market analysis. And normally this is at the end of the show, but for those of you that are watching this on YouTube, you'll know that I shifted things around because I wanted to get a little bigger picture in here. This is, of course, a chart that has got lots and lots on there. And when I zoom in, it'll be a lot clearer. This, some people describe my charts as just spaghetti because they don't understand them. But then when you get into all of the amazing information in here, you see how we use this information to project the markets. And when things don't happen as we expect, well, that is information also, and we get to use that certainly also. Let's take a look here. This starts out with the great pandemic bubble. Let me just zoom in here so that you can see this period to the market peak, and the stock market rallied through this whole period as the Fed was pumping and pumping, and the government just spending and spending. It brought the market up to nearly a 200% of GDP. Other big bubbles broke well below that, like 157% or 135% of GDP in 2000, 2007. This was just extraordinary valuations in here. The everything bubble, everything moved up, and that's why the cryptos did what they did, and why so many things are correcting. Stay-at-home stocks that lost 90% of their value. That's all really what should happen when you have this type of insanity that lifts markets. So here's where we are right now. Let's just take it from this period of the peak. And what we're looking at here are a minor cycle right in here, a dominant cycle right in here, and you can see where it bottomed right there, and a much larger cycle in here that Katie shook out for us at about 36 weeks. And those all point to a bottom out here in the March time frame. So we looked for this bottom to be forming. It came a little bit late for us in here, but then when it did form, you can see we got this upside movement. Now, our projection in here for the stock market was for it to move up to around 4,000. Now, where did that come from? Well, it came from these rising phases right in here, and the upward turn in the reversal scout here telling us momentum conditions had improved. We also had conditions improving in our other significant indicators, which I showed last week, and I'll just show you right now, looking here at our market monitor, which is a good way to see all of our proprietary indicators in there. And let me just unsort this so you can see the SPY, QQQ, IWM, Dow Jones Transports, and the European Stocks 50. You can see in here an overbought condition when this is orange, so is this. So you're likely to get some pullbacks when you see that. But these turned positive, and that gave us the indication that we were in a positive condition. The NASDAQ is the one that was the laggard. It is improved also to neutral conditions, as you can see in here, because of all the buying coming in now. But overall, this is still positive, and we are looking for continued upside move. Our target right up over here. See this major 38% right there? That target that we had right over there is at around 39.90. There is a minor 61.8 right over here. That's around 4,000, just over 4,000. So that was our first target. You see the market has gotten up close to it right there. Now there is another upward track that you see right in here, which takes you up to the major 50%. And here's the intermediate 61.8%. I don't assume that after just 4 weeks off of the low, the market is going to peak. And everything I showed earlier in this major market look, all is showing us that it's likely that that which is supporting the stock market right now, the conditions of a declining dollar, of declining interest rates, all of those are likely to last a number of more weeks, maybe into the early part of January. So that's what we're projecting as a possibility here. And that this level up here is around 41.50, 41.60. So this is our upgraded level as a possibility out over here, all existing in what is a very significant bear market. Then out over here, we get into much more negative periods. So here in December, you see this minor cycle. This is likely to get up in here and then give a pullback and then give us a buy area and then be moving up again into this period right over here and then a failure area. You could say, well, what will make the market move down again? I mean, if the Fed is getting closer to the period where it's going to stop raising, December is probably only going to be 50 basis points. And if that's the case, well, what would make the market break? Well, it would be indications that that the earnings are going to do very poorly, that inflation is not giving that much ground, and the Fed is likely to stay at a tight level for a very long period of time. Here is a picture of your whole bear market, and getting up to this major 50 area that is gaining half of this back is a realistic occurrence before it then has its next downside move, which we project will take out this low that it made over here at that bottom, which was just under 3,500. So we could see it getting up to 4,000 and stopping, 4,070 and stopping, or 4150 and stopping. Those are the important levels that we see in here. And of course, that it all comes from our cycle analysis, swing high, swing low analysis, and all of the important indicators that we bring into our analysis. So that is a look at the stock market, which looks to us like at least another, we'll call it 4 to 6, 7 weeks still to go up in this rally that we're having right now.